All right, let's get right into it. Today, we're unpacking a really fascinating case study, an active investor's actual playbook. And we're going to break down the system that led to a super dramatic move, one that, let's be honest, most people would never even dream of making.
So this is the central mystery we're exploring. And no, this isn't a hypothetical. On a specific day, March 17th, 2026, a professional money manager looked at his system and just sold everything. Every single stock, all of it, moved to a simple money market fund. The big question is, why? Why on earth would he do that? To get that answer, we really have to dig into the philosophy behind the system.
And that brings us to the absolute core of this whole strategy. It's a concept called the risk-off switch. This isn't about gut feelings or trying to guess what the news is going to do. It's about a simple, binary, yes or no decision.
And the metaphor that runs this whole show is right here. Forget about all the complex charts and jargon for a second and just picture this, a fork in the road. Every single day, the market gives you this choice, and you can only pick one path.
And here they are, the only two paths that exist in this system. Path 1 is risk on. That means conditions look good and you stay in the market to grow your money. Path 2 is risk off. Conditions look dangerous and you get out. You move to the sidelines to protect what you have. The trick, of course, is having a clear signal that tells you which path to take.
So what is this risk-off signal? The best way to think about it is like a giant flashing red light. It's an internal indicator, a system that basically measures how willing investors are to take risks. And when that willingness dries up, when that red light starts flashing, the rule is absolute. It's not a suggestion, it's a command.
And this, right here, is probably the most important part. There's no debate, there's no, let's wait and see. The second that signal goes off, everything is sold. It all goes into the safety of a money market fund. Because the number one goal here isn't to squeeze out every last penny of profit. It's to avoid a devastating loss.
Okay, so that's defense. That's capital protection. But what about offense? What happens when the light is green and it's time to make money? Well, let's dive into the risk-on playbook.
So when it's go time, it's not just a free-for-all. This system actually uses two very different approaches to investing. The first is a kind of broad strategy using major market indexes. The second one is much more targeted, focusing on specific industry sectors.
So first up is the index strategy. And guess what? It's another simple fork in the road. The system just looks at what kind of stocks are leading the market right now. Is it the big established value stocks, like a Boeing or a Pfizer? Or is it the high-flying growth stocks like Amazon and Google? You just invest in whichever index is leading the charge. Simple as that.
Now, if you thought that was disciplined, the sector rotation strategy is almost robotic. The rules are purely mechanical, there's no emotion here. Rule 1, you only invest in the top 3 strongest performing sectors out of 11. Rule 2, you completely ignore the other 8. But here's the real kicker, Rule 3. All 3 of those sectors have to be outperforming the S&P 500. The moment one of them starts to lag behind the overall market, it's gone, sold, and that money goes right back to cash. It's a ruthless focus on being only where the absolute strength is.
Okay, so a system with a bunch of rules sounds great on paper, but does it actually work? And what was the specific thing that triggered that massive risk-off signal we started with? Let's look at the numbers and what was happening at the time.
And wow, the performance numbers really do speak for themselves. The Modern Index strategy, for example, has returned about 14% a year, but with 35% less risk than just buying the whole market. The sector rotation strategy has done even better, around 22% a year with 15% less risk. That's the whole point, right? Generating strong returns while taking on less risk. The data is pretty clear that the system has worked over time. So what was the trigger? What was the event that made this manager pull the plug? Well, it wasn't a bad earnings report or a dip in the market that day. It was rising geopolitical uncertainty. And here's the key thing to remember. The stock market doesn't react to today's news. It's a discounting machine. It is constantly trying to figure out what the world is going to look like 6 to 9 months from now. And that future uncertainty is what flipped the switch to risk off.
To really get inside the head of an investor who would make a move like this, to understand the deep-seated fear that drives this whole strategy, we have to talk about something called the avalanche theory. It's a really powerful way to think about how markets actually collapse.
See, a market crash never just appears out of thin air. It doesn't start with a giant explosion. It starts with something small, something that seems totally insignificant. Maybe it's one piece of bad news, or one company missing its earnings. It's just a single snowflake. But then, that one little snowflake, it finds another one, and then another. A little bit of fear starts to build. A small dip in the market makes a few more people nervous. And that snowflake is now a small snowball, and it's starting to roll downhill. It's picking up speed, it's picking up size.
And eventually that snowball gets big enough and it's moving fast enough that it triggers the main event. An avalanche. A total market collapse that just wipes out everything in its path. By the time you can see the avalanche coming, it is way too late to get out of the way. The entire point of the risk-off signal is to get out while it's still just a snowball.
And if you think this is some kind of crazy once-in-a-lifetime event, think again. Since the year 1800, the U.S. market has had a major collapse. We're talking a drop of 30% or more, a staggering 22 times. These aren't black swans. They're a regular part of market history. And the investor behind this playbook believes number 23 isn't a matter of if, but when.
So this all brings us back around to the final and honestly the most important question of all. It gets to the heart of the trade-off this entire philosophy is built on.
This quote really says it all. Look, sometimes the system will tell you to get out, and the market will turn right around and go up the next day. You might miss out on a 1% or 2% gain. That's the price you pay. But in this system, that small price is just an insurance premium. It's the cost you pay to make sure you avoid the 30, 40, or even 50% loss that comes with a real market avalanche.
So this whole playbook, every rule, every decision, it all boils down to one fundamental question that you have to ask yourself as an investor.
What is your number one priority? When it all comes down to it, are you here to protect your capital above all else, or are you here to chase returns no matter what the risk might be? There's no right or wrong answer, but knowing which one you are, that might be the most important investment decision you ever make. If this made you think, comment cash below and let us know.